Welcome. We're diving into a fundamental change happening right now, the shift to programmable money. Money often seems simple, but its role is far deeper than just paper or numbers on a screen. Let's explore what money truly represents. Money is essentially your time, your energy, and your effort, stored in a transferable form. Every day you trade hours of your life for digital balances, trusting that this stored effort will hold value, a powerful social agreement. For decades, the pattern was clear. Earn, save, and slowly build security. Saving money was seen as responsible behavior. Saving meant planning ahead, preparing for the uncertain, and actively protecting your future. This traditional pattern shaped families, careers, and entire economies, establishing a foundation of trust in saving. However, behind the scenes, the financial system doesn't always reward this behavior. Many designers view saving as a problem. From their perspective, money must circulate constantly. When people save too much, the system slows down, spending drops, and growth stalls. This creates pressure, quietly pushing people towards spending instead of encouraging saving to keep the economic engine running. Now we are witnessing a major shift. The definition of money is changing, moving towards something called programmable money. This is not just digital currency. It's a new system where money is controlled through code, allowing it to have built-in rules and limits. This is a fundamental change. Money may no longer be fully yours. It moves from a neutral tool to an active system. Programmable money comes with major implications that impact how we interact with our finances. Your money could come with conditions. It might expire, only work in specific places, or be continuously monitored. The money becomes active, guiding behavior, influencing decisions, and directing value rather than just storing it. This shift isn't random. It's driven by deep concerns within the financial system itself. Financial authorities fear deflationary spirals more than inflation. This happens when people stop spending and hold on to money. In a debt-based system, slowing spending leads to less revenue, job cuts, economic shrinkage, and ultimately, systemic risk. This economic pressure is why the continuous flow and movement of money are crucial to those in control. They want money used, not stored. If people don't spend willingly, new tools, like programmable money, are designed to ensure circulation. As we move forward, understanding this evolution of money from a neutral tool to an active guiding system is essential for everyone. Welcome to an exploration of a fundamental shift in finance, the rise of programmable money and what it means for financial control. During times of crisis, human behavior becomes surprisingly predictable, driven by fear and uncertainty. People naturally become careful, reducing expenses and delaying big purchases, focusing purely on survival rather than growth. Saving becomes the priority. While saving is natural, this mass reduction in spending creates a serious problem for our debt-based financial system, which relies heavily on continuous activity. Economists refer to this continuous spending as the velocity of money. It's simply how fast money moves from one person to another. When velocity is high, the economy grows. Money circulates quickly, supporting businesses and stimulating production. But when velocity drops, everything slows down. In a debt-based system, this slowdown is dangerous. When people stop spending, the entire financial structure begins to shake. Financial authorities traditionally react quickly during downturns, primarily using central banks as their tool. The main strategy has been to lower interest rates, making borrowing cheaper to incentivize people to take out loans and start spending again, restarting the money flow. However, this strategy often fails. When people are afraid, fear is stronger than incentives. They avoid new debt, even when borrowing costs are near zero, creating a major challenge for policymakers. If incentives don't work, what's next? This is where programmable money emerges as a new, more powerful solution. Programmable money shifts the approach entirely. Instead of simply encouraging behavior, it enforces it. Instead of hoping people spend, it ensures they must spend. It allows authorities to attach rules directly to the currency itself, controlling how money behaves and transforming it into a precise policy tool. Let's look at some of the mechanisms of control these systems introduce. One powerful rule is an expiration date. If the money isn't used within a specific time, it simply disappears, effectively removing the option to save. Another control is limiting where funds can be spent. Money might only work at approved stores or for approved items, directing economic activity with precision. This technology brings serious implications, changing the core nature of money. This level of control shifts power away from individuals and toward the central system, increasing efficiency for policymakers. The trade-off is clear: stability and control for the system, at the cost of individual financial freedom. The system begins to depend on code, not just trust. Once this change is implemented, it becomes incredibly difficult to reverse, fundamentally altering the way we interact with currency. Programmable money is changing the very foundation of how we interact with currency. But what are the real-world impacts of this digital transformation? One of the most powerful and transformative features of this new financial technology is programmability itself. Traditionally, money offered flexibility. You could save it, invest it, or hold it for emergencies. This gave individuals control over their financial future. However, programmable systems fundamentally change this dynamic. They reduce, or even remove, the individual's control over their money. The first key feature we must examine is the concept of expiration dates applied directly to currency. Imagine receiving money that must be spent within a fixed period, say 30 days. If you don't use it, the value simply disappears. For individuals, this removes financial freedom. Saving becomes difficult, long-term planning is limited, and every decision is forced into the short term. From a systemic perspective, however, this solves the problem of slow spending. It creates urgency and ensures money keeps moving through the economy. Another significant feature programmable money can introduce is negative interest. This means that if you hold your money instead of spending it, your balance will automatically decrease over time, causing you to lose value. This mechanism further pushes people toward consumption and away from saving, transforming individuals from long-term thinkers into immediate consumers. All these rules happen automatically. They are written into the system's code, executing decisions without delay or resistance, making the system extremely powerful. The removal of physical cash is another vital component in the landscape of programmable money. In the past, cash provided privacy and independence. If policies or banks were distrusted, people could withdraw and store their money, maintaining control. In a fully digital system, this option disappears. Every transaction is tracked, recorded, and visible within the controlled network. Without cash, there is no escape. This allows for the complete enforcement of rules and financial behavior management across the entire population. While programmable money promises efficiency and reduced fraud, it introduces new risks related to centralized control. Money becomes more than just a tool. It becomes a system of influence that shapes decisions and guides actions based on predefined restrictions. The challenge lies in balancing the benefits of efficiency with the need to protect individual financial freedom and independence. Programmable money is rapidly developing, extending its influence far beyond traditional economics. These systems allow money to be programmed with rules, defining how, when, and where it can be used. The potential use of programmable money expands into influencing broader human behavior beyond simple transactions. The core idea is that if money can be controlled, then access to daily life, including essential services, can also be controlled. This control can manifest as potential restrictions on how individuals conduct their day-to-day activities. For instance, spending could be restricted based on certain conditions or predetermined limits set by the system rules. Imagine certain products becoming entirely unavailable to you once a specific financial limit is reached. Travel could be significantly affected if your financial access or permissions are suddenly restricted, making planning difficult. Financial systems could indirectly control movement, linking your physical location to your spending permissions. A major concern is the potential for inequality built into these programmable money systems. Not everyone may be subject to the same strict rules. Large institutions and powerful entities could face fewer restrictions. This creates a gap between those with flexibility and those facing limits, potentially growing wider over time. These systems offer compelling benefits, but they come with significant trade-offs regarding individual independence. Programmable money is often presented positively, promising efficiency, modern security, and better financial inclusion. However, the deeper structure introduces a new level of centralized control, reducing independence at the individual level. Because of these profound changes, awareness becomes extremely important for everyone. Understanding how these systems function allows people to make informed decisions and prepare for their financial future. Diversification is a key strategy. Relying entirely on one system may carry unnecessary risks. Explore different assets and storage methods. The future of money is clearly evolving, driven by digital technology and new structures of control. This shift is gradual, but its impact will be significant, reshaping how we earn, spend, and save. In this emerging world, understanding the system won't just be useful, it will be absolutely necessary for navigating new financial realities.